Look, guys, whatever people tell themselves, the painful reality is that most investors are just guessing. But in the next few minutes, I'm going to tell you the exact moment that you can know that a stock is dangerously overvalued or when a stock is undervalued and a no-brainer. Honestly, this is the clarity you've been missing. So let's start with what valuation is. Now, to clarify the opening, I don't know the exact moment things are dangerously overvalued. Guys, the future is unknown and we're humans, we make mistakes. This is why the whole idea of margin of safety is so important when talking about stocks. Valuation is very simple. It basically says, hey, if I pay this price, what's it worth to me to pay this price based on what I expect the future to have? But like I said, we don't know what the future is going to be. We don't know what the future of Microsoft is. We probably have a range of ideas. We probably have some sort of idea. But that's because Microsoft is a huge company. They're all over the place. It's hard to sit there and see a company like Microsoft massively fluctuating in terms of revenue growth and profit growth. It's probably gonna be pretty much in line with a certain range. Now that compares with a smaller company. And that's why smaller companies tend to get overlooked. They're harder to understand. What does that future look like? Well, could the company grow 5%, 25%, 10%? It's so wide of a range. We've seen tons of companies grow like crazy and then collapse. We've seen other companies grow like crazy and then continue growing like crazy. But at a certain point, you have to understand what the value for the business is. And valuation is basically deciding what is that future stream of cash flow worth to me. Because remember, when you buy a stock, you're buying a piece of a business. You're buying a piece of some sort of cash flow in the future. And the return is based on what you pay for that today. And everybody's going to have a different valuation metric. Some people will say, I'm okay buying this company and making 10%. Other people might say 15%. But where things get messy is when we don't realize that the price we're paying for that future stream of cash flows is actually a 0% return or a negative return. That the future outcomes do not justify what we're paying today. That's where things get scary. That happens when someone doesn't realize that a stock is more than just the price going up and down. We see the market telling us this is the price, but you have to understand the price is in relation to something in the future, not the past. So when it comes to 8 pillars, this is why we created our 8 pillars. Let's pick up a random stock like Google. We have our 8 pillars here. Remember, 8 pillars aren't a way of deciding to buy or sell a stock. It tells a story. And that story will help guide us in the questions we ask next. With Google here, we've got good returns on capital. And by the way, very important for valuation. The higher the returns on capital, the more you should be willing to pay for the company. Same with growth level. If there's a lot of future growth potential, you should pay a higher price. You've got shares outstanding. Are they buying back shares? Remember, buying back shares in and of themselves is not necessarily a good thing. If they're buying back expensive shares, that's no different than you paying more for a stock than you should be paying. Cash flow, has it grown? Revenue, net income and revenue, have they grown? What's the debt like? Guys, the balance sheet's very important. And the reason being is, if you go out 20, 30, 40 years, companies that have bad balance sheets today, which means they have a lot of debt relative to their cash flow or earnings, they're going to have a hard time staying around unless things are really good. But a company like Google that has very low debt, hell, the entire bank could come to them and say, all their bankers can come and say, hey, we're calling all of our loans for you. And guess what Google would do? They'd write a check and say, fine, see you later. Yeah, they'd have less cash, but they'd have no debt anymore. But the two biggest metrics here, the 5-year PE and 5-year price to free cash flow. And in this situation, they're X's. But you got to remember, they're X's only because I said I want under 22.5. Guys, these could be cheap at 30 times earnings over the last 5 years. Now, let's go pull up an exact example here. Let's talk about a company that's gotten a lot of attention, Palantir. Guys, this company has had an incredible ride. Look at this chart here. Look at this chart over the last, 5 years? Hit a high of $45 here, went down to $5 somewhere over here, $5.83 I think it was, and back up to all-time high of $135 just last week. This is some major fluctuation in 5 years. Now, Palantir has a lot of great attributes in its 8 pillars. The thing I love the most, look at this balance sheet. They actually have more cash on hand than total debt, but they have some downsides. They have diluted the heck out of their investors. There are 40% more shares today than there were 5 years ago. They don't have a return on capital. I don't necessarily worry about that because it's a growing company. Cash flow has grown a ton, revenue has grown a ton, net income has grown a ton. But guys, they have negative earnings. I'm gonna ignore that right now. Their cash flow is incredible. But look at this. They're selling for 644 times the last 5 years' cash flow. Let's assume we go to this year's cash flow. They're still selling for 257 times free cash flow. I want you to remember, we don't know if this is too high or too low. However, we can sit there and say, what does Palantir have to grow at to justify paying 257 times its free cash flow? That's always what we're going to say about every company and every investment we make. It might feel expensive, but remember, good growth companies with high returns on capital will feel expensive when you're paying the price, but they could not necessarily be expensive. If I told you hypothetically that Palantir was going to double its profit and free cash flow every single year for the next 30 years, what price would you pay for Palantir? Guys, this would be cheap. If they would double every year for the next 30 years, this would be a cheap price for the company. Assuming they keep shares the same and the balance sheet the same, etc. This would be so cheap, it'd be absurd. Now, if I told you Palantir was going to keep its profit the same for the next 30 years, this is absurdly expensive. That's what I'm saying. You have to remember that valuation is always a price today based on what's going to happen in the future. And that's why I tell people you've got to exhibit caution. You've got to ask what's probable, not necessarily what's possible. Now, you might hit a home run. I just saw yesterday on Market Watch, front article. My wife and I are very conservative. She put $100,000 into a stock and it went up 1,500%. Well, first off, he said 15 times and then he said 1,500%. 15 times is 1,400%. But I won't get into that right now. But what I will say is there was no process there. She bought it, she said, because she saw CNBC and somebody mentioned it on CNBC at $9 a share. There's no process there. That's not investing. That's shooting the dice at the crap table and hitting the right numbers. That's all it is. We're here to teach this process of understanding what you're buying. You might miss out on the 15x Palantirs. You probably will when they 15x over a few months or a year. But what we're trying to do is get that 15, 20, 30x over long periods of time. And that happens by letting things compound. But more importantly, that happens by making the right purchasing decisions. The money is made when you buy, not when you sell. What I mean by that is, once you've bought something, that price that you paid can never be changed. Yeah, you could sell it and wait for it to drop, blah, blah, blah. I get that. But pretty much if you had to stay in that investment, that is the price you've paid. And that's it. That's it. Yes, as it goes down, you can buy more. As it goes up, you can buy more, and it'll change your basis. But once you've made those purchases, that cannot be changed. You've made that purchase. Even when you sell it, that purchase will not change. That's very, very important to understand. So in order to be a successful investor, you've got to be able to see something that others do not see or understand something that others do not understand. With Palantir, the only problem is there are so many people chasing Palantir. That is the problem. You have this because of that. You have 257 times free cash flow for exactly that reason. And unfortunately in investing, it's one of the few areas where the more popular something is, probably the worse it's going to do in the future. We have the Mag 7, and I have a video out there where I talk about creating my own Magnificent 7. And spoiler alert, even though the Mag 7 had the best month they've had since 2022, my performance this year on my Mag 7 has overcome, still continues to be higher than the real Magnificent 7. Why? Purely because they were so hyped. They were so big. And that's hard to make a lot of money when something is so hyped and you're jumping in for some reason. That's the difficulty. And I think that's the reason why Palantir will have a hard time. Now, I'm going to show you Stock Analyzer. We have analyst estimates here that show Palantir tripling, if not more, almost quadrupling its profit in the next few years, and revenue growing at 34, 28, 33, 33, and 31%. But is this enough to justify 257 times its free cash flow? If it's all about just growth, great, then pay 300 times free cash flow. How about 320? You can't. How about 321, 322? Keep going. At what point is it too much? Let's go to the extreme. Would you pay 100 billion, trillion, gazillion dollars for Palantir? No. Would you pay zero for it? Of course. Somewhere in the middle is where, of course, becomes maybe, of course, becomes yes, becomes maybe, becomes no. That's the hard part. That is the art of investing. Now, That doesn't mean you can't find those opportunities, but those opportunities are there. And it's when people, as in general, have turned on a stock. Now, guys, what we have is we have stories and we have a number. These numbers and these stories have to be put together. Unfortunately, for most investors, they focus on the story and only the story. For a real true investor, they'll say, this story is wonderful, but if the numbers don't justify it, I cannot buy the story. That's why we have the stock analyzer tool. This is why we created this thing. We created the stock analyzer tool to put the story and the numbers together to tell you the price to pay. But as you can tell, we have low, middle, and high ranges for everything here, so you can get a range of outcomes. Now, I talked about Palantir. I'm going to do stock analyzer on Palantir, but before I do that, I want to show you Southwest Airlines, because that's the stock that I think is personally undervalued. Now, remember, for anything that's undervalued, there's usually a bad feeling or story behind it. That's the case with Southwest. That's why I believe in buying a lot of undervalued companies that are big. That way I can sit there and hopefully with a proper margin of safety, even if I'm wrong, I still do okay. Now with Southwest, look at the Southwest stock chart. 5 years, it's down 7.5% overall. 10 years, it's basically even. 10 years, it's basically even, but here's what's interesting, guys. You go to the income statement. Last year, they did 27 points. In the last 12 months, they did 27.6 billion. 10 years ago, they did 19.8 billion. So this company is already 50% bigger than it was 10 years ago. The stock is flat. So what does that mean? Does that mean it's a buy today? Not necessarily. If it was massively overpriced before, it doesn't make it a buy today. We can't just look at the stock price, but what we can do is use the stock price being flat for 10 years to say, is there an opportunity here? It's all about asking questions when someone is truly investing. It's not about saying, well, the stock was this before. Well, what if the business is down 90%? What if they have 300% more shares outstanding? Now, if you're asking the question, what does that have to do with anything? Well, if you increase the number of shares by 4x, you now have 5 partners sharing in the money versus 1 before. If I had a company with 10 shares outstanding and the company made $10, that's $1 per share. If I increase the number of shares by 400%, 5x it, it goes from 10 shares to 50 shares. Guess what? It still makes $10 as a company. So now instead of $1 per share, I'm getting 20 cents per share in profit. That's how the manipulations and the increasing of shares can dilute and hurt investors. But with Southwest, here's my thesis. Let's look at before COVID. Before COVID, let me make this a little bit bigger. Before COVID, Southwest brought in $22.4 billion in revenue and profit of $2.3 billion. That's about 10%, a little over 10%. Okay? The year before that, they brought in $2.5 billion, and the year before that, $3.36 billion on even less revenue. So they're making between 10 and 15% a year. Okay. Now what's going on? Well, let's see what's been going on now. In the last 5 years, their profit margin has been negative. In the last year, it was 2%. In fact, we even have a community stock rating page. This is brand new, just came out, I believe, today. So these are the things we're trying to do for the community of like-minded value investors. But guys, 2% profit. That's way below their pre-COVID profit levels of 10 to 15%. Now, they've had problems the last few years. I am hoping, my thesis, that these problems are temporary. But the market's looking at it saying, this company barely makes money. It's selling for 37 times earnings, which actually I'm surprised it's even that low. But it just goes to show you, it's a $20 billion company in which before COVID, they're making $2.3 to $3.3 billion a year. Even at $2 billion, that's 10 times earnings right now. That's incredible. You've got to pay attention to that. That to me is my entire thesis. And that's what I want you looking at. You look at a company like this and say, why are they making 2%? They used to make 10 or 15%. Are there reasons? Well, they had computer system issues. They had a lot of discounts for people because of all these issues. They went through a few years of probably the 737 MAX problems. There were back-to-back problems. Now, do I think that Southwest is down and out and they're done? No. Do I think they have issues? Yes. But I'm hoping that when they turn this thing around, profit will explode with a vengeance. And when it does, hopefully a lot of value will be unleashed. Now, what works for me is I like to buy larger companies that are temporarily misunderstood. And that happens all the time because I always ask these questions. I ask these 3 questions when I'm looking at a company. Okay? Because you got to remember, stock valuation is not a timing tool. It's an expectation tool. The worse the valuation, you have to manage your expectations and say, you know what? Stocks aren't looking too good. This stock isn't looking too good. I'm probably not going to do as well for the next few years as I did previously. Okay. But the three questions I ask when I look at a company is one, do I think this company will be around for the foreseeable future? When I say foreseeable future, 10, 20, 30 years. With Southwest, I do think it will be. Now, does that mean it will be? No, for sure. It could be bought out, but will it go to zero? Will it crash and burn? I don't think so. Question number two, in that 10, 20, 30 year outlook, do I think they'll have more revenue and profit than they do today? If the answer to that is yes, I now have two yeses. The third and most important question, can I pay a reasonable price today that gives me an adequate return on my capital based on that future I see happening? Now, it sounds like a long question, but basically the question is, can I reasonably assume what the future is going to look like and pay a good price today that gives me an above market average return? If the answer to that is yes, I either have to buy the stock or make sure I'm making the right decision for myself and do a little more research. Guys, everything is about expectations. The market is, in the stock market in general right now, I think is massively overpriced. It doesn't mean there's going to be a crash tomorrow. It doesn't mean there's going to be, I can tell when the crash is going to happen, if anything. What it tells me is the future probably won't be as good as the past. The 5 or 10 years from now won't look as good as the last 5 or 10 years. And everything in history shows that. But back to Stock Analyzer. We want to sit here and figure out the Stock Analyzer tool. Sit there and say, okay, what does my future look like? Let's pull up Palantir. I'm going to go back to Palantir. Let's pull up Palantir and see what we see for the future. Okay, so I made some assumptions on Palantir that are very aggressive. I did 3 different assumptions for revenue growth. 15, 25, and 35% revenue growth for the next 10 years. And the great thing about the Stock Analyzer tool is you can do anywhere between 1 and 20 years. Guys, this is a lot of revenue growth. Is it possible? Absolutely. Is it probable? I don't think so. I think 15% a year is possible, and some probably more than I expect. But I look at this saying, if you're expecting 25, 35, or 40% revenue growth for 10 years to justify your investment, that's going to be a tough road. It's hard, it's possible, but it's going to be tough. Profit margin. Guys, last year they did 18%. Free cash flow is 42%. I'm equating them. I'm putting 35, 50, and 65% profit margin and free cash flow margin. Again, I'm putting higher numbers than they've seen for a big chunk of this. That's being aggressive. Now, what's the PE, the price to earnings ratio, and the price to free cash flow ratio in 10 years? I put 20, 25, and 30. I only put that in there because I feel like it's such a hyped up company. I was putting a higher number. What I'd really put in is 18, 21, and 24 probably. Finally, what is your desired return? Remember I talked about margin of safety? 9 or 10% is basically the market return. That is not margin of safety. Because I look at people and say, if you want a 9 or 10% return, just put it in a low cost ETF. You get diversification, you match the market, and you don't have to think. So 9% is just here to say, what do I think the company is worth today based on these assumptions? So I hit the analyze button. The stock is currently at 132. This is why I'm concerned. Even at the highest level, showing me a value of 226 today and a 15% return, it's got to absolutely crush in every single way. Even the middle section, which is difficult, 25% growth rate at 50% margins, it's only a 2% return from today. And the lowest side, talking about a negative 11% return. These are not easy numbers to wrap my head around. Now, let's compare that to Southwest Airlines. I did, very conservatively, 10-year analysis, 2, 4, and 6% revenue growth, profit margin of 8, 11, and 14, same with free cash flow, a PE of 14, 17, and 20, way lower than Palantir. And finally, my 9% return. The stock's currently at 34. Do you see the difference here, guys? Green all across the board, with my lowest numbers at 15.5 to 34% return. Now, before you do anything, do not buy anything because I own it or anybody like that. What it's to say is this. If you had 30 companies that match these on reasonable assumptions, you are going to make a lot of money. If you had 30 companies like Palantir, you better hope that a few of them really crush it because it's got to take up all your returns. But 30 companies like this, and you'll probably do very well. You'll probably be wrong on a few of them. They might be duds, but overall, you're going to make a very, very solid return. And that's what we're trying to do with our investing style. Now, guys, Palantir and Southwest are both absolutely incredible companies, no doubt about that. But I don't care how great a business is. I can't just pay any price for it. That isn't how investing works. That's not how you build wealth. You need to understand the business when you're buying an individual stock. You need to understand valuation, and you need a system that works no matter what the market's doing, because at the end of the day, a true investor merely looks at the market's movements as an opportunity to buy companies that are misunderstood. Back in April, the market pulled back. Early April, all of March, fear was everywhere. Headlines went nuts. What did we say? Guys, this is all just chitter chatter. The markets went back up. We didn't call that. We just sat there and said, this is all useless. I don't care. Now the headlines are much rosier. To us, it's just chitter chatter. We don't care. We have a plan. We know what to look for, and we stick with it. But 20 years ago version of me was a lot like everybody else out there. I thought I was an investor. All I was doing was chasing stocks, following stock tips, getting caught up in the hype, hoping that something would stick. But guess what? If something went against me, I panicked. Why? Because I didn't understand why it would go up or down. That's gambling. That isn't investing. And that's exactly why this channel and this software was created. I built this for myself. I needed the stock analyzer tool. In fact, we created the software because I was using this in an Excel format and people kept asking me for access to it. And we finally said, fine, let's just build it. We built all these tools. We built this community. We have hundreds of videos of exclusive content where we talk to people in our community by themselves. Joining EM gets you access to that software. And guess what, guys? We're very, very close. And we're talking now about making EM an invite-only and application process. We would rather have much better quality people in the community than the masses. If you think you're one of those quality people, you better join now before we actually make it an application. But let me be very clear. If you're just looking for someone who jumps from shiny thing to shiny thing, we're not for you. If you're just looking for stock picks from other people without contributing, we are not for you. In fact, don't even follow the channel. Unsubscribe. That is not the kind of person we're looking to build here. We want a community of committed investors who are in it for the long haul. If that's you, go sign up. If it's not you, maybe it'll change someday. But if you're serious, now's the time. Remember, undervalued doesn't mean boring. It means opportunity. It means buying great companies below their value, buying what is out of favor and misunderstood. And remember, learn from my lesson. Don't just sell something because it's overvalued. Let it run. Because even the most overvalued companies that are running will have their pullbacks as they keep going up. You must pay a premium for a great company and a great story. And if you made it all the way through this, you're ready to take the next step as an investor. In the next video, I'm going to walk you through our full course on how to evaluate and buy individual stocks the right way, because understanding valuation isn't just how you avoid mistakes or minimize them. It's how you build real wealth over time. So click the video linked on the screen and I'll show you exactly how it's done.